I spent over a decade managing money. I've seen how the machine works from the inside, and what I'm about to show you is the most important thing I've ever put on this channel. There is a mission of strategic importance that no politician will ever say out loud, and I can tell you right now, the stock market is no longer a market. It is a covert operation to ensure prices never sustainably fall. This is the chart. The red line, interest on national debt. The blue and green, the entire US military budget. And right here in 2024, the red line crossed above. The United States now spends more servicing all bills than defending its borders. Apparently, our greatest national security threat is our credit card bill. 970 billion in interest this year, heading toward 2.1 trillion by 2036. And that created a secret mission, a mandate that has never been written down, but that everyone in power understands. The stock market cannot be allowed to fall. Not because they care about my or your portfolio, because if stocks crash and stay lower for longer, the government's entire revenue model collapses. And I'm going to show exactly how this operation works in 3 phases. Here is phase 1 and the math that drives everything. This is realized capital gains as percentage of GDP. When stocks go up, people sell. The government taxes those gains, and it's not just investors. Millions of people in the corporate world are paid in stocks, grants, and options, not just cash. When stocks surge, their taxable income surges with it. In 2021, at the market peak, capital gains hit 8.7% of GDP, the highest in 40 years. But when markets crashed, this line falls off a cliff. Now look at this. Individual income taxes, which include those capital gains, are 51% of all federal revenue. More than half the government's money comes from taxing your income and your investment profits. And who pays? The top 10% pays 27%. The top 0.1% pays 33%. Their tax bills are tied directly to asset prices. If stocks drop 20% and stay down, capital gains disappear, tax revenue collapses, and the deficit explodes. This is the part most people miss. The government doesn't protect the stock market because it likes Wall Street. It protects the stock market because the stock market is now the government's largest single revenue source. Let that sink in. The same institution that regulates the market is now dependent on the market for its own survival. And it's not just the institution, it is the people running it. Why do you think we've seen record levels of congressional stock trading lately? Turns out the best hedge fund in the world is just getting elected to Congress. They aren't trading geniuses, they are personally front-running the very system they are paid to regulate because they know it cannot be allowed to fall. But there is a second reason they can let stocks crash, and this one hits closer to home. The top 10% of American households own roughly 90% of all stocks. And that same 10% accounts for half of all consumer spending. So follow the dominoes. Stocks crash, the top 10% stop spending, businesses lose revenue, they cut jobs, your neighbor loses their paycheck, spending drops further, GDP contracts, tax receipts fall, deficit widens. It's like playing financial Jenga. The top 10% portfolios are the bottom blocks holding up the entire tower. You pull those out and the whole thing collapses on everyone else. It's not a recession problem, it's a sovereign solvency problem. The entire country is now structurally dependent on stock prices staying elevated. If this is connecting the dots for you, hit the subscribe button right now. I built this channel to give you the real insights I gained from over a decade of managing money. I'm here to show you exactly how this machine works from the inside, and we are just getting started. This is the cover. They will never tell you this directly, but every policy decision now flows from this single reality. Which brings us to phase 2. So how do you manage 39 trillion in debt without crashing the economy? You use the inflation weapon. Look, debt to GDP dropped from 135% to 122%. Did the government cut spending? Of course no. Asking the government to cut spending is like asking a toddler to do your taxes. Instead, they just let inflation run hot, which pushed up stock prices and nominal GDP, magically shrinking this ratio. The debt didn't get smaller, your dollar did. This is the quiet part said out loud. The government is paying you back in watered down money and they are counting on you not noticing. Which is exactly why the Federal Reserve is desperate to cut interest rates. The average rate on the national debt is only 3.35%. They've already paid $867 billion in interest this year alone. The government is servicing on short-term debt like living off credit card while hoping for a raise. But Goldman Sachs just dropped a bomb. They ruled out any rate cuts for the rest of 2026, they pushed the first cut forecast to June 2027, and they raised the probability of a rate hike from 10 to 20%. A rate hike when your interest bill is already close to $1 trillion. And now the Black Ops gets a new layer. BlackRock just published their Q2 2026 global outlook. The title says it all. Micro is macro. The capital expenditure of 7 hyperscalers, Amazon, Google, Meta, Microsoft, Nvidia, Oracle, Tencent, is going from $400 billion to $800 billion by 2030. The spending of a handful of tech companies is now holding up the entire global economy, and Washington needs this. Dominating AI is a geopolitical arms race, so they need tech stocks to be wildly valuable to fund the infrastructure. Look at the feedback loop. Big tech invests billions into AI companies. Those companies use the capital to buy Nvidia chips, driving massive revenue and stock prices. Washington isn't trying to slow this down. They're implicitly endorsing it. It is part of the mission. But BlackRock also warns that the AI builders are leveraging up. Investment in front-loaded revenues are back-loaded. That means that the whole thing is built on debt that hasn't earned a return yet, and the AI build-out itself is inflationary. It pushes prices higher before any efficiency saves you money. The net effect, more inflation through at least 2030. This is the weapon. Inflation isn't a bug in the system, it's a feature, and phase 3 is where it gets personal. Let me show you the plumbing. The Treasury General account, the government's bank account at the Federal Reserve, spiked at $1.8 trillion in 2020, then got deliberately drained to pump stimulus into the economy. Right now, they're rebuilding it toward $900 billion. That is a liquidity drain and money is being pulled out of the system. The pipes are being tightened before they are getting released. And the G10 excess liquidity indicator, a leading signal pushed forward 6 months, has just turned negative. Every time this has dipped below zero since 2006, stocks have faced serious resistance. This is exactly why I've been raising my cash position to 30%. And now let me be very clear. People hear that and think I'm screaming, sell everything. That's not what I'm saying. I am heavily invested, but for me, someone who has spent almost 2 decades trading and investing in the stock market, short term means up to a year. I'm holding cash waiting for the Federal Reserve to step in and then I'll deploy it for the next cycle. That's not bearish, that's a strategy. But here is the cost of the whole operation. The rest of the world is watching. Saudi Arabia now settles 41% of its oil sales with China in yuan. The dollar's share of global reserves has fallen to 56.8%. And for the first time in modern history, gold has officially overtaken US Treasuries as the world's #1 central bank reserve asset. Gold is now at 27% while treasuries have fallen to 22%. These aren't panic trades. These are countries with 30-year time horizons voting with their own money. And this is why it won't stop. The CBO projects debt held by the public will rise to 175% of GDP by 2056, higher than the World War II. The mission isn't ending and it is just getting started. So how am I playing this? First, I understand the game. The stock market is a strategic national asset. The Federal Reserve will protect it, but the cost of that protection is purchasing power. Every time they print to save the system, the dollar buys less. That's the trade, and it's not changing. Second, I separate the short-term noise from the long-term reality. Like I said earlier, I am sitting on 30% cash position because I expect short-term pain as the liquidity drains. So when the Federal Reserve panics, we get more quantitative easing, more market support, more money printing. They will just go with something else like stability checks, investment program, the patriotic freedom rainbow liquidity initiative. I refuse to be fooled by the labels. And when do I think they will panic? I don't know the exact timing, nobody does, but I do know the threshold. So if the stock market drops 25% or more from its peak right now, that is when the alarms go off in Washington. That is when the printers turn back on. Third, I position accordingly. I am buying assets that cannot be printed. I want assets that hold value when currencies don't. My mission is to protect my purchasing power, not to get rich quick, but also not to get poor slowly. The government will not let the market die, because if the market dies, the system dies. The cost is what your money is worth. Understand the mission and you can still win. Thank you for watching. See you in the next one.